Good morning. As the sun rises over the heart of London and the city stirs to life, the question on everyone's lips is more pressing than ever. What lies ahead for the UK property market? Today, November 9th, 2025, we're diving deep into a topic that affects millions. What's next for UK house prices? Whether you're a homeowner, a hopeful buyer, or simply watching from the sidelines, the future of property impacts us all. The headlines are everywhere, warning of a market at a crossroads. Prices remain stubbornly high, yet uncertainty hangs in the air. Some say we're on the brink of change, while others predict more of the same. For homeowners, the stakes are personal. It's about protecting the value they've worked so hard to build, and wondering if now is the right time to sell, hold, or invest further. For first-time buyers, the dream of owning a home can feel more distant than ever. Rising prices, stricter lending, and fierce competition make the path to homeownership seem almost impossible. The market is tense, and emotions are running high. Homeowners hope for continued growth, while aspiring buyers wonder if the property ladder is slipping further out of reach. Every decision feels weighty, every headline adds to the anxiety. Will prices finally cool, offering relief to buyers, or will they keep climbing, pushing homeownership even further away for many? The answer isn't simple, and the stakes couldn't be higher. The past few years have been a wild ride. Pandemic booms, sudden interest rate spikes, and now a market caught in limbo. The landscape has shifted dramatically, leaving many to wonder what's next. Activity has slowed, but prices haven't crashed. Instead, they're holding steady in most regions, defying predictions of a dramatic fall. For some, this is reassuring. For others, it's a source of frustration. Experts are divided. Some forecast a gentle correction, others warn of a potential downturn, and a few even predict renewed growth. The future remains foggy, with no clear consensus in sight. Is this the calm before another storm, or the beginning of a new era for UK property? The uncertainty is palpable, and the decisions made now could shape the market for years to come. Over the next hour, we'll break down the powerful forces shaping the market, from global economic trends and shifting demographics to crucial decisions made in Westminster and at the Bank of England. We'll cut through the noise, examine the latest data, and explain what it all means for you. Whether you're buying, selling, or simply trying to make sense of it all as a homeowner, our goal is simple: to give you a clear, unbiased look at the risks and opportunities ahead. So whether you're planning your next move or just want to understand the market, stay with us. Let's dive in and explore what's next for UK property. To predict where house prices are headed, we need to look beneath the surface and understand the forces at play. The UK housing market is shaped by a complex web of influences, and knowing what truly moves prices is key to making sense of the headlines. At its core, the market is a tug-of-war between economic forces, each pulling prices in different directions. Some factors push prices up, while others hold them back. Right now, the single biggest driver is the cost of borrowing. This is what determines how much buyers can actually pay for a home. Mortgage rates, which are set in large part by the Bank of England's base rate, have a direct impact on affordability. When rates rise, monthly payments go up, and buyers' budgets shrink. Higher rates mean fewer people can afford to buy, which puts downward pressure on prices. Even a small increase in rates can make a big difference to what buyers can borrow. For many families, this means tough choices, either stretching their finances or putting their plans on hold. The result? Fewer buyers in the market, and less competition for homes. But it's not just about interest rates. The wider economy matters too, and it's closely linked to how people feel about making big decisions. When the economy is growing and GDP is on the rise, people feel more secure in their jobs and more confident about the future. That confidence often translates into big moves, like buying a new home or moving up the property ladder. But if the economy stalls or shrinks, uncertainty creeps in. People worry about job security, and demand for homes can drop sharply. Even the fear of a recession can be enough to put buyers off. Low unemployment is a good sign for the market. When more people are working, incomes are steady, and there's more confidence to buy. On the other hand, rising unemployment, or even just the threat of layoffs, can freeze the market. People become cautious, and fewer homes change hands. That's why economists watch jobs data so closely. It's one of the clearest signals of the housing market's health and future direction. Affordability is the final, crucial piece of the puzzle. It's not just about prices, but how those prices compare to what people actually earn. The ratio of house prices to incomes in the UK is now stretched to the limit. For many, the dream of homeownership feels out of reach. For decades, house prices have risen much faster than wages. This has made it especially tough for first-time buyers, who often struggle to save enough for a deposit or qualify for a mortgage. When homes become unaffordable for most people, demand hits a ceiling. Sellers may want high prices, but if buyers can't pay, the market slows down. No matter how much people want to buy, if they can't borrow enough or stretch their incomes further, prices simply can't keep rising forever. This affordability barrier is now a major headwind for the market, and it's forcing both buyers and sellers to rethink their expectations. In the end, it's these forces, borrowing costs, economic confidence, job security, and affordability, that really drive UK house prices. Despite the challenges, there are reasons for optimism. Wages are finally rising faster than inflation, boosting real incomes and making mortgages more manageable. The UK labor market remains strong, unemployment is low, and job security is high. This stability keeps buyers in the game and underpins market confidence. Forward-looking surveys show a shift in sentiment, more buyer inquiries, more agents expecting sales to pick up. The mood is improving, hinting the worst may be over. The deep-rooted British desire for homeownership keeps demand alive, even in tough times. Chronic housing shortages mean competition for available homes remains fierce. This imbalance between supply and demand helps support prices, even during downturns. Now, let's look at the pressures holding the market back. The affordability crisis is front and center. House prices are near record highs compared to earnings. High mortgage rates make monthly payments a bigger burden, shrinking what buyers can afford. This limits borrowing power and puts downward pressure on prices. The crisis is worst in London and the southeast, but even more affordable regions are feeling the strain. Regional disparities mean prices may fall in expensive areas while holding steady elsewhere. Affordability issues don't just block first-time buyers, they trap existing homeowners too. Many can't afford to move up the ladder, reducing transactions and market fluidity. When people can't move, En dan so tembuan Danmarks stagnates Gamburi. High prices and borrowing costs act as a brake, slowing growth across the board. So, what do the experts say? Major estate agents like Savills and Knight Frank predict modest growth, maybe 1 to 3%, if mortgage rates ease and wages keep rising. They see supply shortages preventing a crash, but affordability will cap gains. Economic think tanks and banks are more cautious, forecasting stagnation or slight real terms declines. They warn that high rates and weak economic growth could keep prices flat or drifting down. The consensus: a slow, uncertain recovery, not a boom or bust. When it comes to the UK housing market, there are three main scenarios that experts and analysts are watching closely. Let's break it down into three possible futures: the optimistic, the realistic, and the pessimistic view. First, the optimistic case. Imagine inflation falling quickly, interest rates dropping sooner than expected, and a wave of renewed confidence sweeping through the market. In this scenario, pent-up demand is unleashed as buyers rush back in, pushing house prices up, potentially by 5% or even more over the next year. Estate agents would see more activity, and sellers might finally get the offers they've been waiting for. However, this rapid price growth would make homes even less affordable for first-time buyers and those already struggling to get on the property ladder. The dream of homeownership could slip further out of reach for many. Next, the central or realistic scenario. Here, interest rates are cut only gradually. Wage growth is steady but unspectacular, and the broader economy remains stable but sluggish. There's no dramatic change, just a slow and steady environment. In this case, house prices are expected to move sideways, fluctuating between a 1% fall and a 2% rise. The market neither crashes nor booms, but instead drifts along with little excitement. This means stagnation. Properties take longer to sell, and both buyers and sellers may feel stuck, waiting for something to change. Finally, the pessimistic case. If interest rates remain high, the economy weakens further, and unemployment rises, the outlook darkens. In this scenario, demand for homes dries up, and prices could fall by several percent, leaving sellers with fewer options and buyers hesitant to commit. Most property experts, however, expect the middle path to play out, a subdued market with little movement either way, as uncertainty keeps both buyers and sellers cautious. For current homeowners, this likely means a period of stability, with little change in the value of their property. For those hoping to buy, the wait for better conditions continues, as affordability and choice remain limited. The market is essentially in a holding pattern, with everyone watching and waiting for a clearer signal about the future direction. Over the next year, all eyes will be on which way the scales tip. Will optimism win out, or will caution keep the market subdued? Government policy is a wild card. Building more homes is the long-term fix, but progress is slow and targets are often missed. Planning reforms and brownfield development are in the works, but real impact takes years. Short-term buyer support schemes, like Help to Buy or stamp duty cuts, can boost demand and prices, but don't solve affordability. With an election looming, housing will be a political battleground. Parties will promise everything from new homes to financial help for buyers. Any change in government could shift policy quickly. Watch for new announcements. They can move the market, even if only temporarily. The government's next move could cool things down or heat them up. The Bank of England's decisions on interest rates are the market's heartbeat. Recent rate hikes slowed the market by making mortgages more expensive. Now, with inflation easing, the big question is when and how fast rates will fall. The bank is cautious. Cut too soon and inflation could return. Most expect gradual cuts over the next 6 to 9 months. Slow cuts mean a gentle recovery. Rapid cuts could spark a stronger rebound. The bank's moves will set the tone for house prices in the year ahead. Every announcement will be watched closely by buyers, sellers, and lenders alike. How can you stay ahead in this uncertain market? Watch these key signals. First, track the supply of homes for sale. Rising listings mean more choice and possible price drops. Second, monitor interest rates and swap rates. Falling rates signal cheaper mortgages ahead. Third, keep an eye on government policy. New buyer schemes or planning reforms can shift demand or supply. Finally, watch jobs data and consumer confidence. Strong employment and rising wages support the market. These 4 signals, supply, rates, policy, and confidence, will tell you where the market is heading. Stay informed, stay flexible, and you'll be ready for whatever comes next. The UK property story is still unfolding. Thanks for joining us. Until next time. Until next.